Hello everyone, this is Tom Fox and I'd like to welcome you to episode 142 of the FCPA Compliance and Ethics Report. Today I take a deep dive into the Goodyear FCPA enforcement action. We'll take a look at some of the underlying facts, the amounts of bribes paid, and really the comeback made by Goodyear when in the face of clear bribes for benefits was able to obtain a Securities and Exchange Commission civil cease and desist order only. The episode comes in at just over 21 minutes. I hope you enjoy it. Thank you. Hello everyone, this is Tom Fox and I would like to welcome you to this episode of the FCPA Compliance and Ethics Report. Today we're going to take a look at the Goodyear SEC FCPA enforcement action. I think there are several lessons to be learned from this enforcement action, and I want to visit taking a little bit of a deep dive into this case today. This case involved a enforcement action brought by the Securities and Exchange Commission, the SEC, and in a cease and desist order brought in the SEC's administrative process. The Department of Justice did not prosecute Goodyear for criminal violations of the SEC, so we have a civil side prosecution only. The bribery schemes involved two international entities. The first was a entity in Kenya, where Goodyear was a minority owner in a locally owned business, and the second was in Angola, where there was a wholly owned subsidiary of Goodyear. The Kenyan entity paid cash bribes of a little over $1.5 million or $1.5 million, and falsely labeled these bribe payments as promotional expenses. In Angola, the wholly owned subsidiary paid approximately $1.6 million in bribes by falsely marking up invoices with phony freight and customs clearing costs. The subsidiary also made payments in cash and through wire transfers to various government officials. Finally, the subsidiary apparently cross-referenced the bribes it paid as follows. As the bribes were paid, the amounts were debited from the balance sheet account, falsely recorded as payments to vendors for freight forwarding and clearing cost. So we had two separate violations of the accounting provisions of the FCPA. That being books and records, which means you need to adequately describe the payments you've made. And second, internal controls violations for the failure to prevent or detect such illegal payments. The cease and desist order says that under Section 13 of the Securities and Exchange Act, issuers are required to devise and maintain a system of internal accounting controls sufficient to provide reasonable assurances that the transactions are executed in accordance with management's general or specific authorizations. Transactions are recorded as necessary to permit the preparation of financial statements in conformity with generally accepted accounting principles or other criteria applicable to such statements, to maintain the accountability for assets, access to assets, to make sure that access to assets is permitted only in accordance with management's general or specific authorization, and the recorded accountability for assets is compared with existing assets at reasonable intervals and as appropriate action is taken for any specific differences. So that's pretty much the general description of internal controls under the FCPA. Regarding the specifications of the bribery, in Kenya, there was a retail tire distributor called Tread Setters. And in 2002, Goodyear acquired a minority interest in Tread Setters. And in 2006, Goodyear acquired the majority ownership and took over the day-to-day operations. Yet, Tread Setters continue to be run by the founders and the local general manager. From 2007 to 2011, Tread Setters management regularly authorized and paid bribes. The practice was, quote, routine and appears to have been in place prior to Goodyear's acquisition of Tread Setters. Both the general manager of Trendsetters and the finance director were at the center of the bribery scheme. They approved the payments for phony promotional products and then directed the bribes be paid. The improper payments to employees of government-owned or affiliated entities in Kenya included to the Kenyan Ports Authority, the Armed Forces Canteen Organization, the Kenyan Air Force, the Ministry of Roads, the Ministry of State Defense, the East African Portland Cement Company, and Telcom Kenya Limited. There was a notation that there was additional 15,000 improper payments to local government officials, including city council members, police, and building inspectors. In Angola, we had a little bit different situation because we had an entity called Trent Tire, which was a Goodyear subsidiary, and was primarily involved in selling new tires for mining equipment. It paid bribes to a large number of Angolan companies, including the Katakoa Diamond Mine, the Electric Company of Luanda, the National Service, Sonagal, and Public Works entities. So we had two different schemes in place. I should say with the Trent Tire, the bribery scheme was put in place by the general manager, and he hid the scheme and generated funds for the improper payment with marking up the cost of tires by adding to its invoice phony freight and customs clearing costs. On a monthly basis, the tires were sold and the phony costs were reclassified to a balance sheet, and then the improper payments were made to government officials. So pretty interesting bribery scheme. I think the key lesson there is from Angola particularly is follow the money. And it really points up the need for internal audit or an external forensic audit of your own subsidiaries to see where the money's going out. They're fairly standard charges for physical products across the globe, or at least there's a range of costs. And if that range is exceeded, that is a red flag that could lead to a further investigation. It would seem to me that this would be precisely the type of situation where a transaction monitoring would be very helpful. If you have a product like tires, you can set a range in any geographic area, starting as large as a worldwide basis, but a continent basis, a country basis, a region basis. Run the sales, and then anything that's below or above a certain range, you can flag for further investigation. When you have this type of service, this type of product, I think it would really lend itself to a transaction monitoring approach. But within the Kenyan bribery scheme, I think it pretty clearly shows a lack of either pre-investigation due diligence or auditing of your joint venture partner when they're the majority owner. Now, I recognize that may be somewhat difficult. Nevertheless, it points directly to the need to do so. But in spite of these pretty clear bribery acts, which would have seemed to have been criminal violations, Goodyear came out of this with no criminal enforcement action against it. So kudos to Goodyear. How did they do this? And that, I think, is the biggest lesson learned for the compliance practitioner. First and foremost, as noted several times in the cease and desist order in the SEC press release and by most commentators on this matter, was the self-disclosure by Goodyear. Self-disclosure is a topic for an entire podcast, so I won't go into the considerations you should take for self-disclosure in this podcast, but suffice to say that Andrew Serezny even mentioned the Goodyear self-disclosure in his recent speech at the CVI Pharmaceutical Conference as an example of the benefits that you can receive from self-disclosure. I've heard Stephen Martin talk enough about the credibility you can obtain through self-disclosure if it's followed up with cooperation and remediation. And that's where I think Goodyear really went the extra mile, and it paid off for them going forward. So how did they accomplish this? Well, after the company received its initial reports, and I should even note how they received the initial reports, because it came through a hotline. And Mike Volkov, I think, really hit it on the head when he brought up this case to show the value of hotlines. And while many people really don't think too much about hotlines anymore, that's one of the techniques that have been around for some period of time. And a large number, of course, hotline calls are human resource issues which don't rise to the level of a compliance violation or perhaps even a compliance investigation. A hotline still is an invaluable resource for learning about internal issues. As Volkov pointed out, that the caller obviously trusted Goodyear would do something in response to the calling complaint, and that's a very good sign. Having a culture of willingness to raise your hand, even if it's through an anonymous hotline, is a significant statement about the culture in your company. And I can't say whether having the hotline and having the report come in through the hotline was part of the calculus used by the Department of Justice or SEC, but because it was mentioned so often, I think it's certainly important for you to consider how robust is your hotline. Are you getting hotline tips? Are you getting hotline calls? If not, why not? Are you publicizing your hotline? This could be something that really saved Goodyear a lot of money. But beyond the hotline, Goodyear took some pretty significant steps to remediate and cooperate with the Securities and Exchange Commission. So it was noted in the cease and desist order that after the initial reports, Goodyear promptly halted the improper payments and reported the matter to the SEC, and I would have to assume that's also the Department of Justice. Goodyear provided significant cooperation with the SEC investigation. This included voluntarily producing documents, reports, and other information for the company's internal investigation, and promptly responded to the SEC requests for information and documents. These efforts assisted the SEC in moving forward. In the area of internal remediation, the steps by Goodyear were equally telling and equally robust. The company got rid of its corrupt local partners in Kenya by divesting its interest and ceasing all business operations. Goodyear is in the process of divesting itself of its Angolan subsidiary. The cease and desist order also noted that Goodyear had actually lost its largest customer in Angola when it halted the illegal payments or the bribery scheme. And I think that speaks to a culture which, even if you're under the gun of an FCPA investigation, is doing the right thing. And that's what the SEC and the Department of Justice want to see, I think, is companies doing the right thing, even in the face of costing them business. The company also took decisive disciplinary action against company employees, including executives of its Europe, Middle East, and Africa region who oversaw responsibility for failing to really ensure that adequate FCPA compliance training and controls were in place at the company's subsidiaries in sub-Saharan Africa. Now, I don't have information about the specific controls that were not in place. Obviously, if you have this much fraud, you have a pretty big gap in your internal controls, and you may not have audited, you may not have looked at it. This could certainly speak to a situation where if you are in a high-risk area, you may need to audit on more than a triennial basis or a biennial basis. If you have a regular audit rotation, you may need to go into certain areas every year. Countries like Angola have a very high reputation for bribery, certainly under the TI, Corruption Perception Index. So this is a fairly well-known situation, and it may be something that you need to invest a little more time in. Even if you can't send in an external auditor, forensic audit team, you can still do testing. You can have your compliance function do testing. You can utilize internal audit. Transaction monitoring is an important tool that's often overlooked and certainly would have perhaps lent itself to Goodyear getting a handle on what was going on in the 5 or 6 years that the bribery scheme continued in both the subsidiary and joint venture. But there's also a number of improvements that Goodyear made to its compliance program, both in sub-Saharan Africa and globally. So these were listed in the cease and desist order, and I think they're important for you to consider, not only in the context of what Goodyear did, but it gives you some idea of current best practices, and certainly I think you can satisfy yourself that if Goodyear put these in place during the pendency of an enforcement action where they're actively cooperating with the Securities and Exchange Commission and quite possibly the Department of Justice, that you would be able to have some satisfaction that they were approved by those agencies and department as well. So what did Goodyear do specifically? Well, in Africa, they instituted both online and in-person training. I shouldn't say instituted, they beefed it up for subsidiary management, sales, and finance personnel. In other words, those who are the most openly on the front line or the first defense of a anti-corruption compliance program. Regular audits were instituted by the company's internal audit function, which was specifically focused on corruption risks. Here, I would suggest that you consider what are your highest risks and really take a look at those. Quarterly self-assessment questionnaires were required of each subsidiary regarding its businesses with government-affiliated customers. This is something that I don't think many compliance practitioners would really think through, but it's really an excellent tool to use. And think about that. It's a quarterly self-assessment, and it requires that the local management, and you can even require local management to certify that the results are true and correct and that no violations have taken place. I think Henry Mixon, my good friend and internal controls expert, would call this a stop and think control, but it's still a control, and it can still be a useful control. And it's a control that probably does not cost that much money. So this may be something that you would want to consider, really a stop and think control. It's almost similar to a employee who turns in an expense report reimbursement form and they have to sign it. Not a lot of cost there, but making them stop and think, hey, I need to make sure this is correct. So additionally, for each subsidiary, there were management certifications required on a quarterly basis, including things over financial controls and the annual testing of internal controls. So once again, showing the testing part of internal controls was important. Goodyear put in a new regional management structure and added new compliance, accounting, and audit positions within that management structure. It's not clear if that management structure was in the region, sort of in Africa corporate headquarters, wherever that might be, if it's in Europe or Middle East, some other location, or in the continent of Africa, but they beefed up that function. The company made technological improvements to allow it to electronically link subsidiaries in sub-Saharan Africa to its global network. This last one really points to what internal controls are around compliance, and they're just good financial controls. There's absolutely no reason that your company should not be linked up electronically to subsidiaries across the globe. And indeed, in today's interconnected business systems, I think it's absolutely mandatory. It's certainly something that the COSO framework talks about. And if you think through, one of the reasons that Avon claimed its expenses were so high in its FCPA investigation, it was simply because the subsidiaries were not linked electronically. And each subsidiary had to be forensically investigated separately. So it shows really the power of internal compliance controls are really good financial controls. But the changes that Goodyear made were really not limited to its compliance function in Africa or even other functions in Africa. At corporate headquarters, Goodyear created the new position of Vice President of Compliance and Ethics, which further elevated the compliance function within the company. They expanded on the online and in-person training at the corporate headquarters and in other company subsidiaries. They beefed up their hotline, even though that's how the original report came in. but it enhanced users' abilities to file anonymous reports online. And Goodyear was also instituting a technological solution for case management of legal compliance and audit to document and track complaints, investigations, and remediations. So lots of best practices there, and lots of things that I think that you can match up and test on your own compliance program and benchmark. So kudos to Goodyear for stepping forward and doing these things proactively. It really points once again that one thing I try to harp on as much as I can, that if you get out ahead of these investigations, but also in the remediation part, continue to remediate during the pendency of the investigation. You could certainly have two teams doing it, and whatever the legal costs were, I assure you it was far below what potential fine could have been to Goodyear. So kudos to Goodyear. Lots of good information in their cease and desist order, which I would commend you to read. I have written about this. Mike Volkoff has written about this. The FCPA professor has written about this. Of course, we all have our own takes. Nevertheless, you can get lots of information that way. If you'd like a copy of the cease and desist order, you can shoot me an email. Or if you have any questions on this, please feel free to contact me. I'm at Tom Fox, and I'm at tfoxlaw.com. So this is Tom Fox, ending this episode of the FCPA Compliance and Ethics Report. I hope you've enjoyed it. Thank you.